Let's kickstart our first conversation of the day, and that's National Pension Scheme, also known as the NPS. It's one of the most recommended retirement savings schemes by personal finance experts. Now, it invests in various asset classes like equity, debt, government securities, and alternate investment funds. Now, to help you reap the maximum benefits when you retire. Therefore, who should consider investing in it? What are the different types of accounts that you should know about when it comes to investing in NPS? How can you earn a healthy pension from NPS? To discuss all of this, I have on board with me Anil Ghelani, Head Passive Investments and Products at DSP Investment Managers. Good evening, Anil. Thank you so much for joining us today. NPS, the most recommended perfect retirement product. Okay, I just want you to help our viewers understand in short, before we get into the details of what kind of accounts one needs to open and what's the minimum to maximum investment age and other queries, give me a brief idea about what is NPS and how specifically it is used for retirement purpose.
Sure, I think you picked up a very good thing. NPS is a very useful pillar for your social security. What it does is that it acts as a voluntary contribution plan under the regulation by the PFRDA, and on an ongoing basis during your wealth accumulation phase, you can keep contributing. It's a defined contribution plan, so the amounts that you invest are predefined, and it gets you market linked returns. So there is a contribution which is defined and the returns are market linked. So in that sense, it's a very powerful mechanism whereby you can contribute small amounts during your life cycle when you are earning, and it accumulates a good corpus for you, which can be useful for you to gain your regular stream of income in the form of pensions at the age of retirement.
Got it. Let's kickstart now. Tell me one thing. Is there any age bracket to invest in NPS and to open a tier 1 account?
So NPS, typically you can start anytime at the age of 18, and structurally you can go on till the age of 60. So anytime in the range when you are between 18 to 60. And then very recently, the PFRD has increased that age to 70. So you can continue contributing till the age of 70. And your account can be opened at any point of time, depending on your need. So it's a very flexible type of a structure whereby you can start investing at a very young age. Typically speaking, as soon as you get to the age of becoming an adult major at the age of 18, you can get it started with.
Which is why we also tell people that the first investment goal that they should be thinking of is retirement, and NPS comes here as a wonderful investment product for your retirement goal. How can one start investing in NPS? What kind of accounts do we need to open? What kind of schemes? What kind of choices in terms of investment choices one should opt for? Obviously, depends from investor to investor, at what age you're investing, what are your financial liabilities and other stuff. But how do you analyze all this, Anil?
See, as I said, as soon as you become major, you can start investing. So from the age of 18 till 70, you can invest. That is the first and foremost. And second thing, as I said, is that it is optional. So you are not mandated to invest over here. Like there are certain other retirement products or retirement plans, government administered funds, like for example, the EPF or the Employees Provident Fund. There is compulsory. Like you and I, we are working in a company where we are getting salary. So it's mandatory that certain component will get deducted and it will go under the EPF. Here, NPS is technically voluntary. That is the first and foremost thing. Then we need to be clear that when,
Even for government employees, it's optional?
No, for that. For government employees, it's mandatory. So any person who is a government employee, working in either of the central government or most of the state governments, then NPS is mandatorily part of your salary structure. So for government employees, it is mandatory. So if you are a government employee, by default, every month from your salary, some component is getting deducted and is getting invested in the NPS.
Okay. What is this all about, tier 1 and tier 2 account, when it comes to investing in NPS?
Yeah. So when we look at NPS core investment, that is what we call as a tier 1 account. That is where you get
investment?
The maximum tax benefits. I'll come to the exact tax benefits in detail. But when you start NPS account, by default, you open an NPS tier 1 account. In the tier 1 account, there is a mandatory lock-in till the time you achieve the age of retirement. However, in the case that you want to have an additional account in the form of a, let's say, checking account or a savings account, how you can add on some savings, for that you have to open a tier 2 account. Now in tier 2 account, there is no lock-in at all. So for your ease of allocation of your money, you can consider to open both one tier 1 account and tier 2 account. Tier 1 account will continue ongoing till the time you reach the age of retirement, and tier 2 you can keep coming in, going out as per your needs. So the benefit over there is that within the same vehicle and the same structure, with the prudent regulation by the PFRDA, you can keep allocating funds both for your long-term needs as a long-term retirement, as well as your intermediate needs or near-term financial goals. So I'll take just one small example, Kavita ma'am.
Sure.
Assume for my long-term retirement at the age of 70, I feel that I need a corpus of, let's say, for example, 1 crore rupees. For that, every month some amount by default is getting deducted from my salary. Assume if I'm a government employee, mandatorily it's getting deducted.
Right.
If I'm a private sector employer, or let's say I'm a doctor or a lawyer, then voluntarily I'm allocating some money over there. That is getting locked in till the age, let's say I reach my at 70. So that one financial goal is going on in parallel. Another financial goal, then let's say in the next 5 years, I want to buy a fancy car. For that I need to save up, let's say 20 lakh rupees. Now for that, let's say if I put aside some small amounts, I can use my NPS tier 2. So in tier 2, I don't have any withdrawal restrictions till retirement. I can withdraw it next 3 years, 5 years, depending on my investment goals and my time to the reaching of that financial goal. And there is no restriction on that. But yes, most certainly, one thing to keep in mind is that in such a case, in tier 2, I don't get any tax benefit.
Right.
In tier 1, we get a very unique benefit that there is a tax rebate when we are making the investments, and also at the time of withdrawal, there are certain tax exemptions on the gains that we make. But in tier 2, there is no such tax benefit. It's like any other investment that you do, either through, let's say, a mutual fund, or let's say hypothetically in the simplest way, amount deposited into a savings account or a fixed deposit.
Okay, so in short, tier 2 can be your savings bank account. That's sort of an arrangement that's provided as per the NPS. Okay, so we can shift money, we can transfer money from tier 2 to tier 1, right?
We can always transfer from tier 2 to tier 1. But
Okay.
once it goes into tier 1, then it gets locked in till the retirement based on the age profile of the person making the investment.
Okay. So, Anil, now you explain me this one thing, that whatever scheme or whatever investment strategy we opt for as per it's provided in NPS, that all investment goes through tier 1 account.
Correct.
Okay. And how does one select what scheme is good for what kind of investor?
Yes, perfect point. Very nice. See, what we spoke about was just the tiering, the tier 1 and tier 2, and the long-term versus intermediate needs. Now we come to the asset allocation. So within, let's say, tier 1, we have got 4 asset classes, as you mentioned very rightly. First and foremost is what we call as, for ease of understanding, I have coined it as ECGA. ECG is very easy to remember. So it's equity, corporate bonds, government bonds, and A is the alternatives. So depending on your age profile and your risk appetite, suppose if you feel that, yes, I have just started working and let's say I'm in the range of 25, 26 years and I have a very long period till the time I retire, then you can allocate higher allocation to equity as an asset class. Now within NPS tier 1, maximum you can go to equity is 75%. So as to ensure a little bit prudent allocation to debt also is being made as a good mix between fixed income and equity. Okay. Maximum equity that is permitted is 75%.
Okay.
So your equity asset class, once you pack it up at 75, you can do either corporate bonds or government bonds. And let's say 5% allocation can be into alternatives, the 4th asset class. Okay. That is completely to your choice. You can make it only full 100% into, suppose you are a very conservative investor, and you feel that, let's say, you are already having little bit exposure through other risk assets, so you want to have 100% only into corporate bonds or government securities, that is also possible for you to do that. 100% can go into government bonds. So it's completely your individual choice. Depending on your risk profile and your appetite, you can decide the asset allocation mix.
One thing I want to understand, the kind of schemes you've mentioned, what if I opt for one style of investment and after a few years I want to change it? I want to change my allocation, my choice of asset classes. Is that possible? Can I do it?
Oh yes, most certainly. So just the overall amount is locked in till retirement, but this asset allocation mix is very flexible. You can change it every year also if you want. And in some way, Kavita, just to highlight, it's prudent also to review this on a periodic basis.
Sure.
See, in the example we discussed, we spoke about, let's say, when you are young professional, let's say in the age range of 25, 26, and you want to have higher allocation to equities. Now, let's say, as you transition further and let's say you become, let's say, 35, 36, or when person reaches 40 years of age, maybe she or he wants to reduce little bit equity, some other liabilities have come on board. Maybe you need to start planning for, some your children's further education. So you want to little bit reduce equity, maybe increase fixed income. So that definitely is possible. In fact, it is very much recommended that, let's say, once in a year, you can review your asset allocation and you can change your asset allocation mix.
Okay, tell me.
Yeah. Just last, in fact, in that sense, PFRDA is very prudent in their approach. They also have come up with certain life cycle stage. So like you can select this kind of approach whereby by default, as per the change of your age, your asset allocation pattern keeps changing.
Got it. Now tell me one thing. Now, as per these asset classes and the kind of choice an investor can make, why can't we opt for more than 75% in equity? Why this kind of a capping?
Sure. Very good point. See, earlier, in fact, this was much more rigid and much more conservative, whereby PFID had put a cap of only 50%. The logic being that, let's say, now take it for example 75%. So the logic being that, let's say you are invested 75% out of 100 into equity. Now equity as an asset class is inherently a little bit more risky as compared to debt or fixed income. Of course, debt also has risk, no doubt, but structurally it's slightly less risky as compared to equity. So the point is that, let's say you invest around 75 rupees from your total 100 into equity, and 25 is fixed income. So over a long period, let's say, for example, 30 years, 35 years, let's say in our example, we started investing when we were 25. And let's say we are investing for around 30 years profile, till the time we reach the age 35 years, maybe 60 years of age. So in that period, that 25 rupees of fixed income or the corporate bond or government securities as per your selection, they will itself grow up to, let's say, come very close to the 100 rupees. Okay, so in that sense, it acts as a cushion or a sort of a capital protection oriented type of a approach to your overall portfolio.
Got it. Okay.
So in a simple way, let's say if you decide not even 75, you do set 50-50. And let's say you have a time horizon of 30 years. So that 50 rupees which you invest today in debt, they will in 30 years become 100. And the balance 50 you have given, they will be your growth potential.
Okay.
So to ensure this kind of a prudent and a sort of little bit balanced approach, the PFRDA had put out this kind of a boundaries that you should try to have at least 25% allocation into fixed income as an asset class, and hence equity got capped at 75.
Okay, let's talk about redemption rules now. When can we withdraw money? First of all, what are the conditions in which we can have prematured withdrawals from tier 1? Because tier 2, there is no lock-in, right? We can invest and we can redeem anytime we want to. But talking about tier 1, how do we go about with premature withdrawals? And after that, after 60 or 75, whatever the maximum age is till the time you can invest, what are the tax implications involved in withdrawal?
Sure. Very good point. Yes, absolutely right. Tier 1, you can take out any point of time. There is no restriction, no lock-in at all from the date of investing. And because of that, we are not getting any tax benefit also. From tier 1, if you want to do any kind of premature withdrawal, that is at which can take place before you attain the age of 60, that can happen whereby you have completed at least 3 years of your starting the NPS. So structurally, at least for 3 years, you have the amount invested and your wealth being accumulated. Then you can do that kind of a partial withdrawal. And this partial withdrawal can be for various reasons which have been specified. For example, critical illness or education or marriage of children. If you want to buy a house property. So the PFRDA's approach is very clear that if it is something which is needing you to enhance your social security, let's say, for example, for like buying a house, then yes, most certainly that is what you have been saving for, and that is what our intention is, that you should have a security and social security. So you are allowed to withdraw money for that. Or if you have some critical illness, right? Means I was saying on the lighter side to somebody, okay, you are asking me to save for my long term, but I need to survive till then. Today I have a critical illness, I need the money for that. Yes, okay, certainly for that you can withdraw the money. Or let's say one of my main objective is to have money for my children, their education or their marriage. That is also part of my overall financial planning or life planning. Right. So for such 8-10 criteria, this kind of a withdrawal is permitted. There is no restriction on that. And this is a very prudent approach. In the very beginning, when NPS had started, I remember this was a very big concern that partial withdrawal was not allowed at all. It was only when you reach the age of superannuation or like retirement at the age of 60 minimum. But now, and that time also it was nothing wrong in that. There are so many instances whereby I used to keep saying, just on the lighter side, one example of a movie of superstar Mr. Amitabh Bachchan. It's a movie called Bagban, where he withdraws his retirement funds and then gives to his son, and then son takes it away and he is left with nothing, and he suffers a lot. I mean, without going into much detail. Hence, PFRDA's rule, in my view, also was very prudent that okay, we enforce and we ensure there is a lock-in till you come to your retirement age. But then over the period, this is a very prudent approach that for certain criteria, for certain urgent requirements, there is a withdrawal facility possible.
So after 60, you can remove 60% of your corpus. That's EEE. Okay.
That is exempt. Yeah. 60% you withdraw. That is exempt from any tax. So entire amount that you have gained also during that entire period. Let's say you started from 18-20 years of age till the time you reach 60, right. You might have gained so much amount that is fully tax-free.
But then 40% we need to buy an annuity which is also taxed. Don't you think this is one aspect of NPS which really takes it slightly away from being a very investor-friendly product? Or you
think... madam. I will explain you. Just give me 1 minute. It is very, very well planned, and if with this show your viewers can get clarity, I think it will be very perfect. See, let's say for example, anything that you take out is tax-free, like 60. Let's say you have collected 100 crore, 100 rupees, 60 rupees you can withdraw, that is tax-free. Now, on the 40, on 40 rupees, there is no tax you have to pay. Just to be clear. But on the 40, every year from next year, now today, let's say I have attained the age of 60. Okay, I say, okay, from my 100 rupees, please give me 60 rupees, that I want to do my stuff, I want to go on a world tour, I want to buy a fancy Jaguar car, whatever I want to do, tax-free, I did it. Now 40 rupees, no tax, and on my 60th birthday, but 61st year, on 40 rupees, let's say I'm getting some annuity payment in the form of interest. You can't think of it mentally in your mind. Now on that annuity, I have to pay tax, right? Till the time, let's say after I reach 62, I'll get another 4 rupees, 63, another 4 rupees. So that amount of that annuity, that certainly I have to pay tax. It can't be forever tax-free. That is the case for any EEE exempt product. That when you withdraw the money, you have tax benefit, no tax paid. But after that, wherever you invest that money, let's say you park it in a FD or you park it in a mutual fund. And from that, whatever income you gain year on year, let's say from 60 to 80, let's say today medical science is advanced, not even until, let's say, I'll live to the age of 100. So each year, whatever income I earn or accrue on that I have to pay tax. That is quite
But
clear
then
cut.
what are these annuity schemes like? How do we get a option to select as to which one we want to go for?
Oh yes. That is also very perfect. That we get an option to select which annuity plan you want to take, whether we want, and which particular company's annuity plan also we can decide at that point of time. And it's the beauty of it is that we are not mandated to do that selection right now when we start investing. So that time full flexibility is given to us that you at the time of your retirement when you are taking that amount, that time you decide based on your life needs and your financial requirement, you can decide at that point of time. So just I'll take example, madam. Suppose that when I reach 60, 65, whatever, when I'm retiring, 60 is the bare minimum when we can do that, but there is an option. You can continue little bit further till the age of 75 also.
Got it.
For simplicity's sake, let's assume at the age of 60, I decide I am retiring and I want to withdraw my corpus. And if at that time I feel that, I need little bit larger amount for annuity. I don't want lump sum right now. I don't want to go for my world tour. I can even change that 40. Instead of 40, I can say 80 rupees you annuitize and give me more monthly fees, monthly pension.
Right.
Or if I do even 40, I can decide at that point of time that I want that annuity to come to me for lifelong, or after me, I want it to be given to my spouse. Or suppose I feel like my spouse is so even more financially secure than me, so I don't want it after me to go to anybody directly. The entire lump sum will go to my legal heirs. So because sitting today, I can't foresee that what will my family and my financial background be. So that part is very conveniently left fully open with full flexibility, and at that point of time we can have the decision making done.
Now, NPS is entirely a retirement product. If someone has a
it's a very
well-diversified...
plan that you keep it open right now,
Yeah, so, but what if someone has a well-diversified product, a portfolio? Do you still think one should have investment in an NPS plan, or that can be skipped if you have your portfolio lined up as per your goals? How important it is to invest in NPS just for your retirement, considering you have better options if, of course, you've, at the right time invested in it?
See, I'll tell you, better option is subjective. Like, for example, I'll give my first example. I work in the asset management industry. In that sense, well thought out financial plan that, okay, I have some X amount in some mutual fund, some amount in real estate, some in commodity. But still, personally speaking, I am also every month investing in my NPS Tier 1 account. Why? Reason being that this is your additional pillar of your social security. Okay, you have your other financial plans meeting your goals and your objectives, no doubt. And that's very prudent. Here, it is an additional pillar of your social security and a very unique pillar at that, because it is giving you an additional tax benefit.
Sure.
So for all of you, understand the kicker that can come in from the tax saving in year one itself. You are getting full tax benefit. So it's a very unique proposition whereby you can get extra tax benefit over and above your 1,50,000. So today, let's say, as a salaried employee, Kavita, you and I can invest and get tax rebate only up to 1,50,000. We can invest into some mutual fund ELSS plans or some long-term FDs, life insurance premium, etc. But all that amount gets capped with 1,50,000. NPS is the only product whereby such allocations which we do on an annual basis as an investment, you get additional benefit over and above the 1,50,000.
Absolutely.
So,
yeah, ATCCT, that's a section you get 50,000 tax benefit extra on NPS. So this was all in our NPS classroom for today. Anil, thank you so much for joining in and explaining us the basics of NPS. But if at all you have any question which is about NPS or about your investment strategy, any mutual fund, you can send your question. You can email your question to themoneyshow@etnow.tv, and we also have a WhatsApp number 865-797-4571.